How does GAAP relate to accounts receivable? Have you ever wondered how businesses keep track of money owed to them? Today, we are going to discuss how generally accepted accounting principles relate to accounts receivable. This topic is essential for anyone interested in financial statements and accounting practices. First, let's clarify what accounts receivable means. It refers to the amounts that customers owe a company for goods or services provided on credit. Under generally accepted accounting principles, these amounts are classified as current assets on the balance sheet. One of the key requirements of generally accepted accounting principles is how accounts receivable should be recognized and measured. Companies must record these receivables at their net realizable value. This means they should adjust the total amount owed by customers based on what they realistically expect to collect. Next, we have the allowance for doubtful accounts. This is a method mandated by generally accepted accounting principles to estimate bad debts. Companies must predict which receivables are unlikely to be collected and record an expense called bad debt expense. This estimated amount is credited to a contra-asset account known as the allowance for doubtful accounts. This approach ensures that expenses are recognized in the same period as the related revenues, which is a fundamental principle of accounting. When it comes to estimating uncollectible accounts, businesses have several methods to choose from under generally accepted accounting principles. They can use the percentage of sales method, the percentage of receivables method, or the aging of receivables method. The choice of method often depends on the company's past experiences and the nature of its receivables. On financial statements, accounts receivable are presented net of the allowance for doubtful accounts. This means that the balance sheet shows the net realizable value, giving users a clearer picture of expected cash inflows from these receivables. Another important aspect is revenue recognition and timing. Generally accepted accounting principles requiring that accounts receivable be recognized when the company has fulfilled its obligations, even if cash has not yet been received. This practice supports accrual accounting and ensures that revenues and receivables are recorded in the correct period. Transparency and integrity in reporting accounts receivable are also emphasized by generally accepted accounting principles. Companies must maintain proper internal controls to ensure accurate recording and timely collection of receivables. This practice also supports tax compliance and readiness for audits. Lastly, it is worth noting the differences between generally accepted accounting principles and other accounting frameworks, such as international financial reporting standards. While they share many principles, generally accepted accounting principles have specific requirements that affect how receivables are reported and managed. In summary, generally accepted accounting principles play a vital role in governing accounts receivable. They requiring companies to record receivables at net realizable value, estimate and report bad debts through an allowance account, and present receivables transparently on financial statements. Understanding these principles is essential for accurate and reliable financial reporting.